Hello everyone, welcome back. In this chapter, we are going to be taking a look at internal controls and cash. The two main areas of discussion here, we're going to start off with discussing internal controls, and we'll look at what these are in general and then a little bit specific to cash. And for internal controls, we're just going to go at this at a high level. So I'm not going to take too much time or go into too much detail. You don't need that detailed understanding yet. You'll get that in future accounting courses. And because of that, the main focus of our chapter will be on bank reconciliations. Internal controls, as it says here, they consist of the plan and processes put in place by management to help protect assets and financial records. So there's risk within any business that either assets could be stolen, so whether that's cash or inventory items or office supplies, really anything like that. Or there could be issues that go on with the financial records, so errors or misstatements within financial records. So internal controls are put in place to help prevent or detect if something goes wrong. So make sure that assets aren't available to be stolen and that financial records are accurate. And that's what it says down here. So the objective of internal controls, to have accurate, reliable financial information, to have effective and efficient operations. So this means optimizing the use of resources and minimizing expenses. So efficient operations, not having goods go missing. Preventing and detecting error and fraud is another objective. And then complying with laws and regulations. So internal controls, yes, they relate to accounting because we're talking about financial information here. But they're more than that. They actually look at just the general operations of a business to make sure that they're running smoothly, efficiently, and effectively, and there's no fraud or theft going on. So you've, I'm sure, experienced many internal controls in your life, likely as a customer, but probably if you've been working as well, you would have had these in your role as an employee. You just don't think about them that much. Sometimes they're not complex, sometimes they are, but they're out there and you would have experienced them. So we're going to go through an example quickly to just give you an idea before we go any further. So you bought yourself a pair of runners. You took them home, wore them around the house to test, and they end up giving you blisters. So you go back to the store, stand in line, get to the cashier and tell him you want to return the shoes. The cashier asks for your receipt. He scans that and then also scans the barcode on the shoebox, and he pulls up the return in his system. He looks in the shoebox at the runners to make sure they are the item on the return. The cashier says that things look good and you will be getting a refund of $85 in the same method you paid, which was cash. But he needs a manager to process the return, so he calls his manager over. The manager checks what the cashier's done. It looks good. She enters a code on the computer, hits enter, and the cash drawer opens and a receipt prints. She makes you sign a copy of the receipt and then gives you the $85 cash, and you head on your way. So typical situation, I'm sure you've gone through this on your own. You've purchased something, it didn't work out, so you returned it and got a refund. So what were the internal controls here? Well, first, the fact that the cashier asked for your receipt. So that was one. So a receipt was needed. This proved that you bought the shoes and that the sale was processed through the system. So he checked the shoebox, compared it to the receipts in the system. Yes, those were all matching. So you did buy those shoes and it was processed. It also proved when he scanned the receipt that you hadn't already done a return, because if you had, that would have shown up in the system. And then, as I said, that the shoes being returned were the ones purchased per the receipt. So that's one control. Another control here is that the manager is actually needed to process the return, and that she needs a code in order to do that. So the manager was authorized to process this return and give the cash, but the cashier, he was not. So there's that 2 levels there. The manager has the authorization, but the cashier does not. So the manager processes the return and needs a code. And then the last one here is that you, the customer, need to sign a copy of the receipt. So this is done to prove or to say that you're agreeing that this return has been processed and that you got the money back. So the risk here is that someone could try and return something that they didn't really buy. So by you now signing this receipt, that return is processed in the system. And if someone happened to steal a pair of these same shoes, they couldn't come back to this store and say, I want to return these and get a refund, because they would no longer have the receipt, or it would be now processed in the system to say that it's already been returned. So that is also a control. So you can see here, in everyday life, you go through situations like this where controls have been put in place to look at these risks and make sure nothing can go wrong here, or help at least prevent it. Okay. So there's 5 components to internal control. They're listed here, and you can see that this excuse me, acronym for crime can be used as a way of remembering them. But there's more details on this next slide. So we're going to go through this pretty quickly. And in general, when you start looking at internal controls, the first thing that will happen is the company will do a risk assessment. So management and owners and all of those type of people, they'll take a look and see where something could go wrong. So where an error could occur, or where theft could happen, where fraud could happen. So where are these risks? And then they're to decide, if there's a risk here, we need to put a control in place. So then they would go through and they would look at different control procedures or activities. So what can actually be done to reduce or eliminate this opportunity for fraud or error? And then as they put these controls in place and start operating them, they also need to monitor controls. So keep track or take a look at these and decide, are they working? Is it doing enough? Do we need to switch anything up? So a company may have someone, an internal auditor, or they may have an external auditor, or both. So these are people looking at those controls to make sure that they are working adequately. And then beyond that, there's also some important things. So the information and communication system. For accounting side, you need to have a system that ensures only authorized users are able to access the information. And also this system needs to capture and communicate important information. And then lastly at the bottom, this is an overall control talking about an environmental control. So it's when management makes it clear to employees that the organization values honesty, integrity, and ethics. So this is often called the tone at the top, where management puts that general look and value over these honest ethics and integrity. So often a company will have either a code of ethics or a code of conduct. So you may have signed one of these when you started as an employee. You're expected to read this document and sign it to say, yes, I will operate within this business with ethics and following the conduct that is noted. Okay, so we've looked at these 5 components. Now we're going to focus on control procedures and activities. So once you assess these risks, what are some things that can be done? So the first one that's noted here is the assignment of responsibility. And this basically just means that each employee is given a specific responsibility as part of their job. So they're noted, here is your specific responsibility as part of your employment, and therefore this makes them accountable. So if something goes wrong, you know who's responsible for that. An example of this would be a cashier at a retail store. They would each be responsible for their own cash drawer. So when you're getting groceries at Walmart or whatever you're getting there, you see several cashiers lined up. Well, they're each responsible for their cash drawer. So if that drawer has cash missing during their shift, we know that they are the ones responsible for that. And you can sort of link these together, these two, with proper authorization as well, but they are also sort of separate. So proper authorization just means that there's procedures in place so that only authorized personnel can do certain tasks. So in the example we looked at with the shoes, only the manager was authorized to process the return and open the cash drawer to give that refund. The cashier himself wasn't. So only certain employees would be authorized to do certain things, and therefore that would be part of their assigned responsibility. So those kind of go together. The next one is segregation of duties. And this is really important, and it's a great control if you have enough employees to segregate or separate the various duties related to a task. So we see here, we kind of use the acronym of CAR. So you want to separate the custody of the assets from whoever is authorizing the transaction to have them, and separate that from the record keeping. So a really quick example. You've got Boyd and he works at an auto body shop. He's a mechanic there and he needs to order some parts. So we're looking at, well, who can authorize that transaction? So who is able to order the parts? Who actually gets custody of them when they're delivered? And then who records this transaction? So let's say Boyd, he's a little shady. So he's a mechanic at this auto body shop, but on the side, he also fixes cars out of his own garage. So Boyd, he's thinking, well, I have this job at my home. I have to fix up that car this weekend. I'm just going to try and order some parts through the company in order to get them to pay for it, and I can use it on my own job. So save him some money. So if Boyd himself, he's able to authorize that transaction. So he places the order. When they're delivered, he receives those, and then maybe he even records the transaction, but he might give the receipt to someone in the accounting department to record. So if this is the case, if Boyd can do the authorization and he has custody of the assets, there's no segregation of duties there. So Boyd could say, yeah, I'll just order what I need. I'll take those parts home and someone else is going to record it and pay for it. So that's a risk. Therefore, you would want to separate these duties out. So one person, a separate person, a purchaser could order these parts. Someone else might receive them, and then someone else records them. And eventually Boyd gets the parts to use at his actual job. So you're not going to order and pay for those unless they're needed for mechanic work that's going on in the auto body shop itself. So I've gone through this example in more detail later in the videos as well. The next part here is documentation and records. So this is just saying that you need evidence of the transaction and the events that occurred. That helps prove why something happened, and show when it went on and the amount that was paid. So when you issue receipts, like we saw in the shoe store example, that is one. There's often shipping documents when goods are shipped, receiving documents when things are received. So lots of this documentation and record about what's going on. Next, we see physical controls. So this is actually having some sort of physical item in place to help control this. So for example, having a safe or a vault where cash might be kept. That's a physical control because if it's locked up, no one can get there. Security cameras are another example. The little tags that you see, sensor tags on clothes in stores so that they beep if someone tries to walk out with the tag on that item. Those are all physical controls. But specifically related to counting, you can also have physical control be a password on a computer that's needed. So unless you have that password, you're not able to get into the accounting records to record something. And then the last type of control activity is a review and reconciliation. So reviews will be done for important things by independent reviewers. So for example, a manager. If we think about cashiers, I said that they're responsible for their own cash drawers. So at the end of their shift, they would take their cash drawer and they would have to count that and they would cash out at the end of the day. So they would compare their cash to the receipt, so to this documentation or to a till tape. They would review that and make sure that the cash in the drawer agrees to what the register said they should have from the transactions from that day. So the cashier would do that, but it needs to be reviewed by a manager or by somebody else. They're not just going to trust the cashier because if they did, they could steal something or make those records incorrect. So someone will review that. And then reconciliations are when you compare two or more documents. So we're going to look at bank reconciliations. So when we do that, we compare the bank records in our general ledger or our T account. So what's been recorded in the accounting records, and we compare it to the bank statement. So what does the bank actually say has come in and out of our bank account? So comparing different items allows you to make sure things are accurate. So various types of control activities in place. We've just touched on them briefly. If you go into future accounting classes, you'll likely take an audit class, and that is largely focused on controls and how you audit those and what can be done to prevent risk. So these are general controls, and then what is specifically done, what specific control activities a company uses, depends on what risks they have. So what processes or activities do they actually have going on in their business, and therefore what risks are there, and then the size and the nature of the company as well. But internal controls are important. As I've said, they happen in everyday life. You maybe just don't think about them, but they're really important to protect assets and also make sure financial records are accurate. Okay, so we'll take another look at an example here. Greg works the late shift at a local movie theater. There are times when he sells the tickets and takes the tickets as customers enter the theater. Standard procedure requires the ticket taker to tear the tickets, give half to the customer, and keep the other half. To control cash receipts, the manager compares each night's cash receipts to the number of ticket stubs on hand. So, how could Greg take the money from the theater's cash receipts and hide the theft? So Greg, he's selling the tickets, and then once the movie's about to start, he also takes those tickets from the customers. Okay, well, Greg, first of all, one thing he could do as part A here is he could just not issue a ticket, and he would keep the customer's cash himself. So he sells the ticket, but he doesn't physically give a ticket to the customer, and therefore he just pockets their cash. So then when the manager at the end of the night, he's checking the ticket stubs. Well, Greg never gave that customer a ticket. So he wouldn't, or the manager wouldn't know that cash is missing. Another part could be that he could give the customer the ticket, but then when he goes to take that ticket from the customer, instead of saving it, he just puts it in his pocket or throws it in the garbage. So again, the manager's not going to know that that ticket was sold, and if the cash is missing, if Greg took it, he wouldn't realize that. So part B says, what additional steps should the manager take to strengthen the internal control over cash receipts? So the first, and likely the best one, would just be to have 2 separate employees. So Greg sells the tickets and someone else takes these tickets from the customers as they go into the theater. That's the best, but since it's the late shift, it's probably not that busy. The theater likely doesn't want to pay another employee. So something else they could do was that the manager, if he's there anyways, he or she, could count the number of people in the theater. So they count how many people are watching the movie, they could multiply that by the cost of the ticket, and that would equal the amount of cash they should have. So that would be another step. Or they could have pre-numbered tickets. So every time Greg sells a ticket, and here they would want to have some sort of a sign where the tickets are being sold to say that you need a ticket to enter the theater. Therefore, when the customer buys the ticket, they're going to ask, hey, I need my ticket to get into the theater. If they have pre-numbered tickets, they can then account for these. So the manager would check what the first number was at the start and then look at the end to see what's left, and he would be looking for all of those tickets in between because they should have been sold and given out. So what is the internal control activity weakness here? And this would be segregation of duties, because Greg is doing both of these jobs and therefore he has this, or this risk exists that he could commit some sort of theft. And then part D says, what electronic devices are often used at a concert or event to ensure legitimate tickets? And that's where you have the scanners and the barcodes on your ticket. Or now you can do it on your phone, but you have that code that needs to be scanned. If you don't have a legitimate ticket, it won't read it and they won't let you in. So another example that we see here. So there are limitations on internal controls. Cost benefit is one. When you have a lot of strict internal controls, it's expensive. So business needs to decide, is the cost worth the benefit? So maybe if they don't have that much that could be stolen, they don't have a big fancy security system. But something like a retail store where theft is it's a very big risk, they would have more internal controls to prevent that theft. Collusion is also a big one here. So when 2 or more people work as a team, that's called collusion. And if that exists, so if 2 people are working around the controls together, even strong internal controls will fail to protect the company. Management override just looks, or is the idea that management, they're in charge of the internal controls and they have the top authorization. So it's easier for them to just ignore these controls or to go around them without any detection. And then lastly, human error, of course. So fraud, it's an intentional act of stealing or misstating financial statements. If someone decides that they want to, they're intentionally doing this, it now becomes fraud. So there's a couple examples here of how you could fraudulently misstate the statements. And then why does fraud happen? It's called the fraud triangle because there's these 3 points and you need all 3 for fraud to exist. So there must be some kind of pressure, either personal, so someone needs cash personally, for example, to pay their bills, or it could be business related. So a boss is pressuring an employee to do something. For example, they're pressuring the accountant to accrue revenue to meet some sort of goals. You also need rationalization. So this is finding a reason to justify doing something wrong. So for example, if an employee thinks they deserve a raise, but they didn't get it, they may decide they're going to compensate themselves by stealing something because they deserve that since they didn't get this raise that they've worked so hard for. And then you also need the opportunity. So if there's control weaknesses, you have that opportunity that allows theft or fraud to happen. So you can't necessarily eliminate pressure and rationalization. Therefore, we need to eliminate the opportunity by putting controls in place. Okay, so that's a general idea of internal controls. I know I took a little bit of time here. It's important to know, but also note this won't be tested as strongly or as much as the bank reconciliations. So have this general idea of internal controls, but you don't need a really specific amount. It's not going to be tested as much.